Hello, this is David Jensen with your March 25, 2023 Economic and Markets Update. Okay, if you'd like this presentation, please give the video a thumbs up. And these four locations are the platforms where I post my thoughts in social media. Okay, a couple of quick slides here, review, because it feeds so importantly into understanding what's going on with interest rates and the debt markets. But we've had from 1970 to 1980, M2 money stock, or the money outstanding, increased by 2.7 times, during which period gold and silver increased by 21 and 24 times. From 1980 to today, there's been a 13.5 time increase in M2, the money outstanding, or 1,350%, but gold and silver have underperformed. Gold has only doubled, and silver is still less than half its 1980 high price after that increase in monetary debasement. So the monetary inflation during this time ran into a financial paper asset bubble that was generated by increasingly low interest rates during the period that gold and silver were controlled by the Bank of England. This was part of the Thatcher government Big Bang economic reform in 1986 that gave the oversight of the gold and silver markets in the UK to the Bank of England, who are the money printers. The problem with that, of course, is that the gold and silver are the primary warning system for excess money creation by the money printers themselves. Okay, so what happened when gold and silver were hobbled? We've had a secular rundown in interest rates, as you can see here, from roughly 20% down to zero, run rate is zero here for better part of a decade. And then now a spike now higher in interest rates after the loose money policy of the Fed from 2020 on. So the issue here is that the loose money policy has driven price inflation, is forcing now interest rates higher in a fashion that we hadn't seen previously. Okay, so what is the effect of this spiking interest rates? Well, the first thing that we're starting to see now is that the banks, which carry large amounts of bonds on their balance sheets, have $2 trillion in losses. These losses have been hidden until now, but we've seen a number of banks start to blow up because of these losses. Bank runs triggered by deposit holders recognizing the problem that exists inside these various banks. So the issue going forward here is that these banks now are experiencing a solvency crisis. It's driven by the higher interest rates. Okay, note this bank solvency crisis is occurring before there's any meaningful increase in delinquency or default on the loans outstanding. You can see this on the lower right, that at the end of 2022, delinquency and defaults were very low. But at the same time, we can see here this Financial Post article from February 14, 2023. 1 in 6 Canadians say they are likely to default on a major loan as rate hikes pinch. And if you look up this article, you'll see that the survey indicated that these defaults on major loans would occur in the next 60 days from that time. So we can expect this red line here on the right to start running higher now as the tremendous impact of the interest rate spike on the very large amount of outstanding debt bites consumers. And here we can see this graphic. This shows all of the major bank failures since 2000. We see this cluster here, 2007 through 2012 period. Washington Mutual was the largest bank at that time that failed, and now we can see the first two, Silicon Valley Bank and Signature Bank, and there's a whole slew of others that look like they're in trouble. Offshore, there's Credit Suisse and Deutsche Bank. I'm personally watching the Bank of America. The stock chart looks terrible, and that is the second biggest bank operating in the US. Okay, so the bank solvency crisis occurred before the loan delinquency crisis. Total system debt is $92 trillion, of which 58 trillion is securitized or tradable. The Fed interest increases to date over the last 12 months have added $4 trillion of annual interest payments onto the U.S. economy. All Western economies and central banks have followed the same policy of blowing massive debt bubbles over the last 40 years, and then a wildly loose monetary policy since 2020, which has driven this price inflation that we're seeing due to monetary debasement, and then consequently has been spiking the interest rates higher. These economies, our economies, they cannot sustain this debt burden, and debt default is coming, which is going to be the second shoe to drop now in the banking system. Now, it's not just the banking system that's at threat. Since 1980, you can see this run up here in securitized or tradable U.S. debt, up to $58 trillion. The investment capital was locked in the bond market for 40 years during this long bull market. As interest rates went lower and lower and the value of these bonds went higher and higher, there was a tremendous appetite. But the problem that we have right now with the spiking interest rates and the default and the incipient financial system problems is that our central banks, they can't redo QE with 6% CPI price inflation that's now running even after our economies were made dependent on 0% rates. And the challenge that we face and the risk of this rapid onset hyperinflation is that a fraction of the bond market and stock market capital moving to commodities into real assets of enduring value, that $1 trillion of the $58 trillion bond market, and call it another $40 trillion stock market, can send prices of food and energy, precious metals, absolutely through the roof, and send interest rates much, much higher at the same time. And then this will ultimately lead to a good old-fashioned, call it a Latin American currency crisis. So we're now experiencing the central planners crisis. Their solution to the monetary and economic crisis that we're heading into right now that they've created is, of course, going to be the central bank digital currency. Central bank digital currencies will give complete control of citizens to the central planners after the central planners have collapsed our economies and currencies. The permanent solution is decentralized sound money, gold and silver, 4,000-year history is money. But as we all know, that's not a favorite of the oligarchy. But citizens do have a choice and a voice in this matter by voting with their feet. Gold and silver are assets that are nobody's liability. Physical metal held by the investor is nobody else's liability. It's an asset onto itself. And the final note here, this is a choice for you to make. You choose going forward. Will it be the central bank digital currency or will it be a independent monetary unit which is age-old and proved over the millennia? Okay, that concludes the presentation for today. I'll close just by saying these are, again, the 4 social media platforms where I post information, and I look forward to speaking to you through the commentaries there and in the next video presentation that's coming. Thanks very much.